Hey everybody, it's Jennifer Bolgen, and I want to welcome you to today's session. I'm really excited. We're going to be doing these sessions each and every Friday at 12 noon, and these are weekly value sessions. I want to provide education and information for people who are looking to secure funding for their businesses. Maybe you have a business idea that you've been sitting on and you haven't had the funds available to get it off the ground. I want to provide information as well as resources to allow you to put that business into fruition. If you're an existing business owner who has already been generating revenue, there's a variety of different options for you if you're looking to secure funding. A lot of people are just familiar with the traditional bank lending process. However, there's a lot of alternative lending products that are a lot more flexible, that provide a lot of great opportunity for individuals that may not necessarily qualify for traditional bank lending to be able to get between $25,000 to $150,000 plus in funding for their business with very little documentation. So I'm really excited to share those resources with you, as well as information on how to secure funding for real estate. If you are an investor or somebody who's looking to get into real estate investing, there are a lot of different ways that you can fund your real estate deals. So we'll be talking about some of the more traditional avenues, as well as some ways that you can fuel that with products such as self-directed IRAs or infinite banking, which is the process of starting your own family bank. So we'll be talking about a lot of these great topics. So I'm really excited to share that with you. Today, what we are going to be talking about is how to maintain or build an excellent fundable credit profile. And I'm kind of hammering in a little bit about credit because it is one of the most key components to, pretty much everything that we do in society nowadays. You can't, get an apartment. You can't get good insurance rates without having excellent credit. And definitely when it comes to securing funding for your business, securing funding for to purchase real estate, it's even more important to really understand how that works and what constitutes a fundable profile. So what I'm going to be doing is sharing with you today. Let me go ahead and share my screen with you. One second. Let's see. Excuse me for having some technical, trying to get this up. Hold on. There we go. Oh, you see, I got 100,000 things on my screen. Let's go back. I'm actually going to pause the share. Hold on one second. Gotta love technology when it works. Okay. I'm going to go back and pull this up. So yes, like I said, we'll be doing this each and every Friday. I was kind of trying to figure out what a good day to host these sessions was going to be. And I think Friday is kind of like one of those slow down days for a lot of people. And it ended up working out well. Okay, so let's go ahead. Let me make sure. Okay. Let's go ahead and resume our share. Okay, so here we go. Again, what we're talking about today is how to maintain or build an excellent fundable credit profile. And this is presented by me. My name is Jennifer Carroll Bolgen. If you're not familiar with me, I'm also known as the First Lady of Funding because I can help you with all of your funding needs, whether it be from funding your business to funding your real estate transactions to personal funding, anywhere in between. I've got you covered. So I'm really excited that you're here and you're checking us out. And yeah, so let me just share a little bit about my company. The company is called Wealth and Legacy Unlimited. And what we do is we help small business owners obtain funding, purchase real estate, improve their credit, and close more sales so they can grow their business faster and make more money. So we have a variety of products and services underneath this umbrella that are designed to help you to do all of this. But if you are a small business owner / entrepreneur, we have services that will help you to increase your profits. So who we serve small business owners, entrepreneurs, and startup businesses. So even if you are not established, you're looking to start a brand new business, we do have products and services to help you, and we can help you to obtain funding. Our mission is accessibility to funding and to equip business owners with the knowledge, tools, and resources necessary to build a profitable business and create a life that they love. Now we know, I'm a serial entrepreneur. I've had numerous businesses, and I know a lot of times when you are an entrepreneur, you can get so caught up in your business that it encompasses like all of your life. You're spending 10, 12 hours a day, 6, 7 days a week working on your business. And while you may enjoy your business and love your business, it may not create that balance, and it may not allow you to create the true life that you love. I don't know about you, but I know for me at least, and for a lot of business owners I talk to, they got into business for the freedom. And, working 10, 12 hours a day is not it's not going to constitute real freedom in a sense, because you are tied to your business. So our services are designed to help you to create the freedom that you envisioned when you first got started in your business. We want to help you to get the funding that you need, be able to hire help, be able to invest in your marketing, your advertising, so that you can scale your business faster, get your profits up, and start living the lifestyle that you truly want. Now, one of the newest things that we've just introduced is something called the Credit and the Capital Club. And what it is a community that we've established to help business owners come together, share information, tips, tools, and resources that are designed to help them grow their business faster. What we do in this community is we educate in the areas of personal credit, business funding, personal funding, real estate investing, short-term rentals, self-directed IRAs, tax planning, infinite banking, and so much more. So our company itself is Wealth and Legacy Unlimited, and this community that we have established is called the Credit and Capital Club. So you are invited to join our community, the Credit and Capital Club. It's absolutely free to join. You can go to the creditandcapitalclub.com and get immediate access to join our community. So definitely invite you to do just that. So let's get into it. Let's talk about how to maintain or build an excellent fundable credit profile. So let's talk about what makes up a good credit profile. A lot of people don't really understand like how their credit score is determined. So here are the essential elements of your credit profile. You have 30% of your credit score is, well, let's start with the 35%. 35% of your credit score is constituted by your payment history. That means how you make your payments. Are you making your payments on time each and every time? That is 35% of your credit score. So that is actually the biggest portion of your credit score. I know I talk to a lot of people that sometimes, they get overwhelmed, all this stuff is going on financially, and they say, oh, it's not a big deal. I just, missed one payment. That is the majority of what constitutes your credit score. So it's really, really important that you make sure that you are very, very on it when it comes to your payment history. That is one of the most important elements of all of them. The other aspect, the second most important aspect of your credit profile is the amounts owed. That actually makes up 30% of your credit score. So again, when we talk about amounts owed, we're talking about your credit utilization. How much of your available credit are you actually using each and every month? So let's just say that you have a $10,000 credit card and you are using $9,500 of that available $10,000. You have a 95% utilization. So that is going to ding your credit score 30, that's 30% of your actual credit scoring. That's going to ding you quite a bit. So definitely be careful about how you use your credit, your available credit, because it is a big portion of how your credit score is rated. Another really important aspect of your credit is the length of history. How long have you actually had credit? I have clients sometimes that come to me and they're like, hey, I've got like a 780 credit score. I can't get any credit. What's going on? Like, I have a perfect credit score. And then I take a look at their credit and they've only had credit for, 6 to 8 months. That's great that they've been able to build that great of a score in that period of time. However, a big portion of how you are rated, separate and aside from the actual number, is how long that you've had the credit history. So yeah, that's something to keep in mind there. Another important aspect is how much new credit that you have. How many inquiries have you had into your credit profile within the past 6 months? That's 10% of your credit score. So again, how creditors kind of view it, if you have, let's just say within the past 6 months, you have 10 inquiries into your credit, to them, that means that you are desperate for money. That kind of concerns the creditors. They feel like, something must be going on financially that makes this person just be applying for all this new credit. So again, you want to make sure that you're really very careful about inquiries and applying for credit that you don't need. It definitely can affect, it's a portion of how your credit score is rated. So that's 10%. The other aspect is your credit mix. That's 10% of your credit scoring. So credit mix just means how many credit cards do you have in comparison to installment accounts? Like, do you have both installment accounts and revolving credit? That is credit mix. When you show that on your credit score, it actually shows that you are responsible and you have a history of paying different types of accounts. So creditors really like to see a mixture, not just installment accounts, not just credit cards, but a mix of the two. So again, in order of importance, number one, payment history. Again, you absolutely must pay your bills on time, every time, and maintain a high credit score. Number two, amounts owed. You must utilize under 30% of your available credit in order to maintain a high credit score. This is something a lot of people are not really aware of. We talked about utilization, but ideally you want to stay under 30% utilization on any credit card accounts that you have. And the lower that you can keep your utilization, the better in terms of how your score will be rated. So, you know, a lot of times people will say, wow, I have this card that I use for my bills every month, but then I pay it off. It's totally fine if you use it throughout the month. You have a $10,000 card, you charge up $9,500, but then you pay it off at the end of every month. That's totally fine. The main thing that you want to keep in mind is that when you get to the end of the month or your bill is due, you want to keep that utilization under 30% when the statement comes out, so that it reports to the credit bureaus that your utilization is under 30%. The next and most important, again, is the length of credit history. Ideally, you should have at least 2 years or more in history to obtain funding. Again, they want to see a history that you have been able to manage your own credit, and 2 years is sufficient in that regard. I know a number of years ago, people were, getting funding specifically only having authorized user credit cards on their profile, and they were able to get funding. However, creditors have since tightened up on that. And while trade lines, what's called trade lines or authorized user trade lines, can still help your credit profile, increase your score, and add credit depth, it is not something that you can't just only have authorized users on your credit profile and get funding. You do need to have at least 2 years of your own personal credit history on your profile in order to obtain funding. That's something that you should keep in mind. The next important aspect is new credit. Have you recently been applying for a lot of credit? Do you have a lot of inquiries? And credit mix, what do you have a mix of accounts showing that you can use your credit responsibly? So for those of you that are not familiar with different types of credit accounts, what are the different types of credit accounts? I know I just mentioned revolving accounts, installment accounts. You may have been like, well, what does that mean? Your credit mix is only a small percentage of your overall credit score. You don't need to have a quote unquote perfect mix of accounts in order to qualify for financing. However, it's still a good idea to have a few different types of open accounts. Here are the most common types of credit that can help diversify your credit mix. Number one is revolving credit. Revolving credit refers to any account that lets you continuously borrow against it up to a certain amount. This includes things like personal lines of credit, home equity lines of credit, and credit cards. With revolving credit, you're responsible for repaying what you use plus any interest or fees. So revolving just means like, hey, I've got an account, they're giving me up to a certain dollar amount. I can charge up to that amount, and then once I pay it off, it will go back down to, or the available line will go back to what my limit is. So that's revolving. Installment accounts is a loan that must be repaid in fixed payments, usually monthly. These loans typically come with an interest rate, either fixed or variable, which is tacked on to your monthly payment amount. Common types of installment loans are personal loans, auto loans, and mortgage loans. So again, an installment loan is basically a loan that you pay off each month over time. It's not going to go back up. It's just something that you're paying off over time. So personal loan, auto loan, mortgage loan, those are all examples of installment accounts. So what does constitute a good credit mix? Here are some credit mix examples. Here are a couple of examples of what a good credit mix might look like. You could have an auto loan, a credit card, and a mortgage, a student loan, a personal loan, and an auto loan, an unsecured credit card, a secured credit card, and a personal loan. Ideally, you should have this is again based on my experience. The credit bureaus themselves say that there's no secret sauce in terms of credit mix, in terms of how many accounts that you should have. But what I've found is ideally you should have at least 2 credit card accounts and 1 to 2 installment accounts of different kinds. So when I say installment accounts of different types, maybe a personal loan and a student loan. You could have a mortgage and a auto loan. So those are examples. These are pretty much what you would want to have on your credit report to show that you are responsibly able to use different types of credit. So let's talk about understanding your credit scores. What is a good credit score? You've probably seen this table and you're probably kind of familiar with it. Excellent credit is going to be in the 800 to 850 range, and poor credit is between 300 to 579. Good credit is generally considered around between 680, 739, and that's kind of where you want to be, at least on the low end. Ideally in the very good and excellent range is where we all want to see you. So that's giving you an idea of what a good credit score is. What are the different credit scoring models? Credit scoring models are statistical analysis used by credit bureaus to evaluate your worthiness to receive credit. I'm not going to read all of this, but basically what you would want to know about credit scoring models is that there are different models. I'm sure you have pulled your credit before, and over here, one score was, 700. The other score somewhere else was like 620. And they could be like humongous differences. And, it can be really frustrating for people because they work on their credit, optimize things, get their score where they want, where it should be, and get their credit pulled. And then based on a particular scoring model, their score is a lot lower or a lot different than what they anticipated. But what you should know is that scores generally range from 300 all the way up to 850. And lenders use credit scores to help determine the risk involved in making a loan, the terms of the loan, and what the interest rate will be. So obviously, the higher the credit score, the lower the interest rate, and vice versa. So let's talk about some of these different scoring models. First of all, you have the FICO scoring model. This is the one that most people are familiar with. It's actually considered the most reliable, and it has the best track record. It's been around since 1989, so it's definitely been here for quite some time. The classic FICO scoring model gives consumers a number between 300 to 850. A score under 600 is considered poor, and a score above 740 is considered excellent. The latest scoring model that is available is FICO 9, and it debuted in 2014. The major difference in the FICO 9 model is that it puts less weight on unpaid medical bills. This was actually something that I was really happy to see when it came out because, again, having worked in the credit industry for quite some time, what I was finding is that a lot of my clients who were coming to me with credit challenges, it wasn't based on just irresponsible use of their credit. It was that somebody had gotten sick and they were either bombarded by excessive medical bills or they were sick and unable to work. And as a result, they became behind on their payments. So with this new scoring model, they've actually put a lot less weight on it. So your credit score will not take as big of a ding based on the fact that you may have gotten sick. More changes were actually added in 2017 when Equifax, Experian, and TransUnion removed all civil judgment data and many tax lien records from credit files. Also, collection agencies and debt buyers were prohibited from reporting medical debts until they were 180 days old. So again, this is something that has helped quite a few people in their credit score. FICO 8 is the version most heavily used by the lending industry. Unfortunately, a lot of creditors have not integrated FICO 9. However, FICO 8 does penalize consumers for spending close to their credit limit every month and offers leniency to those who made isolated late payments, meaning one that arrived more than 30 days late. So FICO 8, if you're using, a lot of your credit, they are really, really hard on you for that. But they also are not going to tumble your score as much with one late payment. I wouldn't go too far with that because I've actually seen people lose about 50 points with one late payment. So to me, that's pretty substantial. When FICO releases a new version of its scoring model, lenders do have a choice whether they upgrade or stay with the version they have. And many lenders opt to stay with the version they have because it's just expensive to upgrade. So you're going to find that quite a number of creditors use FICO 8. And the only way to know the FICO score model that they are using is to ask the lender that you're dealing with. Now let's talk about the Vantage score model. The Vantage score model was introduced in 2006 when the three major credit reporting bureaus decided to offer FICO some competition in the credit score business. Their scoring model is quite different, as you will see. They have high weight on your payment history. Whether you pay on time is the top predictor of risk. Remember that late payments are a negative that can appear on your credit report for up to 7 years. They put extreme weight on the age and type of credit. Actually, 21% of the weight is on that. And what they're asking here is, what's the mix between your length of credit history and your account? Are you paying on a 30-year mortgage at the same time you're paying on a 5-year car loan and your monthly credit card bills? If you can handle all of that with on-time payments, you will do very well in this category. So again, managing your credit, how long you've actually had the credit, is 21% under the Vantage scoring model. They put extreme weight on your credit utilization. It's dividing your balances by your available credit. It's recommended, again, to keep your utilization under 30%. Medium weight, your total balances, that's 11%. It's your total debt, both current and delinquent, similar to credit utilization. By lowering debt, it gives you a higher chance of increasing your credit score. So again, how much total debt that you have is weighted within the Vantage scoring model. Something that carries low weight in the Vantage scoring model is your recent behavior. It deals with newly opened accounts and the number of hard inquiries. A high number is not a good sign for your credit report, but it's not a super weighted item within the Vantage scoring model. And extremely low weight, your available credit at 3%. So it's the amount of credit you have available to use. Keep in mind that the Vantage score model is used by Credit Karma, a service that provides your free credit score and report along with your credit monitoring and advice. This is something to keep in mind because a lot of people use Credit Karma and they get really excited because their credit score, hey, my score is like 780, on Credit Karma. And then when they pull it through a FICO scoring model, their score is closer to like a 670. That is because their model that they use is totally, totally different. So that's something to keep in mind. And what you want to know is that when you're monitoring your credit, you want to monitor your FICO score because that is going to be the most widely used model. Let's just briefly talk about other scoring models so you're familiar. Outside of the conventional and well-known scoring models, there's also the TransRisk. It's based on data from TransUnion and determines an individual's risk on new accounts instead of existing accounts. Because of that specialized nature, there's not much information available about the TransRisk score. Accordingly, it isn't utilized by many lenders. It has been reported that an individual's TransRisk score has generally been drastically lower than their FICO score. Experian's National Equivalency Score. It assigns users a score of between 0 to 1,000 with the typical criteria of payment history, credit length, credit mix, credit utilization, total balances, and the number of inquiries. But Experian has never publicized the score's criteria or weight. In Experian's system, a score of 100 means that there's a 10% chance that at least one account will become delinquent in the next 24 months, while a score of 900 means a 90% chance of that. This is an alternative scoring method of 360 to 840. 840 is good, 360 is bad, making it more compatible with the FICO model. So something to keep in mind here is there is an alternative model that again, a score of 100, there's a 10% chance that one of your accounts will become delinquent. That is actually good. On the opposite end, a 900 means that there's a 90% chance that your account has become delinquent. So that's something to look at. The Credit Expert credit score is developed to help businesses approve new account candidates. It inspects credit reports for ways to raise its score quickly or detect false information. By improving these scores, that should lead to more loan approval for customers. Now, this is something that I do within the mortgage lending industry. We have the ability to do something called what's called a rapid rescore. And that is if somebody has information on their credit report that's inaccurate, or you've recently paid off some debt and you want to rescore the credit so that it actually reflects that lower utilization, then we could use this Credit Expert service and get your information updated quickly. And this is really valuable when it comes to getting mortgage approvals, getting different types of lending approvals, because again, if you have recently paid something off and then your credit line does not report to the credit bureaus until like 28 days from now, then you ordinarily would have to wait all that time. This kind of service allows us to quickly update that information. We also have the CE credit score. The creator of this scoring model, CE Analytics, was unhappy with the current model of customers paying for their credit score and companies hiding how their credit scores were revealed. This is a free service available at Quizzle, and it's meant to create a free, transparent, and accurate credit score. They're scoring from 330 to 830, and the model sister company, Quicken Loans, uses it for credit determinations. So some of these scoring models are proprietary to various companies, so that's something to keep in mind. You also have your insurance score. Insurance companies use an insurance credit score to determine your risk as a customer. Insurance scores range from 200 to 997, and generally a good score is 770 or higher, while 500 or lower is considered poor, but it varies in different types of insurance. It's wise to monitor your insurance score because that's how your premiums are determined. So some of that, doesn't necessarily apply for the usage that we're talking about in terms of funding, but it's always good to understand how these scoring models work so that you're familiar with it and understand that. So let's talk about laying the groundwork for a strong credit profile. What are some tips to establish a positive credit history? If you do not have any type of credit, you can easily start with a secured credit card. I know a lot of people don't necessarily like secured credit cards because it's not very sexy, putting your own money down, but it is quick, it's easy, and it works. There are plenty of companies that will be secured for a period of just a few months. And after you've proved a positive payment history, they will convert it to a unsecured card and return that money to you. So something to keep in mind there. You definitely always want to make your on-time payments. You want to keep your credit utilization low, and you want to maintain your accounts for an extended period of time. One of the biggest mistakes that I see with a lot of people is that they close their credit accounts and they think that they're doing a good thing. They may have paid off their credit card and say, you know what, I'm not going to use this credit card. I'm just going to pay it off. I'm going to close it. And they close the account and then they see their score tumble 30 points. And this happens quite a lot. A lot of people don't understand that the credit scoring system is kind of wacky in that it penalizes you for closed accounts. So even though you may not be using a card actively, it's a good idea to keep that account open and, just keep maybe $1 balance on the account just so that it remains open. Something to definitely keep in mind there. So let's talk about beyond the credit score, some other crucial factors that come into play. Going beyond the credit score. Your credit score is just one part of the equation when it comes to positioning yourself for funding. Other factors that lenders consider is your income stability. How long have you actually had your business? Is your business profitable? If you are a startup, how long have you been employed? Is your income stable? One of the things that you need to know is that if you are a startup business, the lender is going to look at your current income. It's not a way to get funding. Basically, if you got to think about it logically, if you had a person that, just came up to you that you don't know, have no relationship with and said, hey, I want to borrow $100,000, but I don't have any income. I don't have a job. I don't have a foreseeable way to pay you back. I can pretty much guarantee that you would not give them that money. It works the same way with lenders. They want to see that you have some income stability. So if it's not coming from your established business, they're going to be looking at your current income as a W-2 employee. How long have you been employed? Is your income stable? Then that leads us to our next section. What is your debt to income ratio? Most lenders want to see you to be under 38% in terms of your debt to income ratio. That just means how much that no more than 38% of your income is going towards your debt. That's ideal. That's what most lenders would like to see. Of course, there are plenty of exceptions, but that's just a rule of thumb. The other thing that they're going to be wanting to see and look at, potentially, not all the time, but depending on the type of loan program you're going through, they want to look at your business plan and prospects. Do you have a clear plan of action in order to implement your business? A lot of times people have these ideas in their head, they're circling around, or they talk to their friend's cousin who has a business and it sounds like a good idea, but they haven't written anything down. They haven't done the projections. They haven't done the numbers to see if this is actually going to be a profitable business. So that's something that lenders are definitely going to want to see and understand in order to help you move forward with funding. Another aspect is collateral. Now, do you own a property or other assets? If you have a business that, and depending on the amount of funding that you're looking for, some SBA loans will require that the owner of the business have some type of collateral. That could be your primary residence. If they're giving you $300,000-$400,000, and your business is not generating, commensurate to that level, they want to have some type of collateral to know that in the event of a default, they can, they have something to fall back on there. So that's something to keep in mind in terms of your business there. Let's talk about positioning yourself for business funding. You definitely must proactively position yourself for funding. And some of the ways that you can do that is by crafting a compelling business plan, like we talked about just a moment ago, showcasing your industry knowledge and expertise, highlighting growth potential and revenue projections. So again, you want to make sure that you really have a clear understanding of the path to profitability with your business. Lenders don't necessarily like to just give you money and have no idea how you're going to use it or how it's going to produce revenue for you and also allow you to pay them back. So having a clear understanding yourself of these important points will help you to be able to get the results that you're looking for when it comes to presenting to lenders. Let's talk about the role of relationships. Networking and relationships is extremely important when it comes to funding. You will be surprised just being out and actually talking to various people within and outside of your industry, just networking and sharing information. You may be able to find potential investors or lending options just in the process of networking. Professional relationships can impact your funding opportunities, and that could take the form of industry connections. So maybe different industry associations, different leagues or anything like that. You can also participate in mentorships or even your supplier relationships. All of these are important factors when it comes to potentially getting some new funding opportunities. Now we're going to talk briefly about the application process. Navigating the funding application. These are just generic things that may be required on a funding application. Depending on the particular type of loan program or particular type of funding program, some do not require any type of documentation. They will approve you based on your good credit alone. So that is a consideration. However, depending on the particular program, these are general guidelines of the type of documents that you would be requested of you. So that would be your tax returns. You need your 2 years tax returns, business tax returns. If you do not have a current operational business, they're going to be wanting to see your 2 years personal tax returns. You're going to want to have your bank statements. You're either 2 to 12 months, depending on the program, and depending on whether you are an established business or a startup. It could be, if you're an established business, it would be your business bank statements. If you are a startup, it would be your personal bank statements. Some lenders are going to request a business plan. Some lenders are not, but it's always a good idea to have one in place so that you are prepared for that. And you also want to have a profit and loss statement that's showing what your business has been doing. Of course, you want to make sure that you have a strong credit profile, which is what we've been talking about. Make sure that you've been handling your credit or managing your credit in line with what we've already discussed. And you want to address any additional lender requirements. So what I've listed here is not totally, what any lender could potentially ask you for. It's obviously going to depend on your particular situation, but these are some general rules of thumb in terms of what they're going to be requesting so that you can have an idea and be prepared for when that presents itself. So in conclusion, What I want to just reiterate to you, you want to have a strong credit profile. It is essential to have strong credit, but it is not the only factor when it comes to securing business funding. So just keep that in mind. It definitely is essential though. When it comes to positioning, it involves your business plan, your relationships, and more. So definitely when you are looking to get funding, you want to make sure that you have covered your bases. You have explored various relationships, business relationships that you have. You have a clear business plan in place so that you understand what these funds will be used for, and how they will equal profits for your business. And you want to, of course, make sure your credit is in order. We talked about that. And you want to also be open to diversifying your funding options for optimal results. As I mentioned, we are going to be talking about a variety of different funding options over the next, over the next few months. We'll be talking about those things. However, when it comes to diversifying your funding options, it could be, getting funds from or soliciting funds from your family or friends. It could be going through traditional lending, like what I'm discussing. It could be starting your own family bank, which we were going to really dive into over the next couple of weeks. I'm really excited to share some of that information with you. And it could be, utilizing a self-directed IRA, using your retirement funds that you already have and directing them towards your own business. So those are some things to keep in mind when it comes to positioning yourself for your funding. So if you have questions and you want to get pre-approved for funding to see what you qualify for, definitely check us out. Go to wealthandlegacyunlimited.com/funding app, and you can submit your information for a pre-approval to see exactly what you may qualify for. And again, if you have any questions, need any assistance, you can feel free to call or text me at 404-748-2754. And again, I do invite you to join the Credit and Capital Club, to plug into our community. We're going to have valuable inside the community only training and resources, as well as great networking. So make sure that you join our community as well. So I'm glad that you joined me. Thank you for sharing this time with me. Hopefully you got some really good value out of the information I shared with you today. I look forward to connecting with you, and I will talk to you very soon. Take care.